equities traders at Axis Bank say they expect the thin market liquidity levels to impact trading in the bond and treasury bills market. Meanwhile, investors show a strong appetite in the 2026 instrument despite a 13.4% interest rate. Tobechukwu Ikpe, Treasury Team Member at Axis Bank, joins me now for more market updates. Tobe, thank you so much for joining us on the show today. Talk us through the high points of this week and the market response since the midweek T-bills auction.
Okay, thank you for having me. So for this week, what we saw at the money market was the week opening a repo. Basically what that means that banks were net borrowers from the central bank, and it was just about over 100 billion. So that led interbank rates to over around 20% at the start of the week. It remained elevated until yesterday, closing around 23% levels. So for the fixed income market, there were two auctions this week for the bond auction and for the treasury bills auction. The bond auction held on Monday, where the DMO offered 360 billion. At the auction, we saw it was undersubscribed, and we saw a subscription of 291 billion. 70% of it was largely on the 30-year paper. That was where most of the interest was, and we saw the rates close at the highest level we've seen this year at 16.25. Post-auction on Tuesday, there was a little bit of apathy on those bonds, but because of the depressed level of market liquidity. By Wednesday, the second auction held, which was the NTB auction. At this auction, we saw an offer of 152 billion. This was heavily subscribed at over 640 billion subscription, and as expected, rates went up about 43 basis points on the 364-day paper to close at 12.98%. So because of the renewed interest on Wednesday at the Treasury bills auction, we saw markets rally post-auction on Thursday, that was yesterday, on the bond space as well, given the significant yields on offer in that space. On the run papers, the 29s, 33s, 38s and 53s, we saw interest on all the papers yesterday, and we expect that demand to continue to persist given the high level of yields that are currently on offer in that market. For the T-bills market today, we're not seeing much activity as the rates have already traded down to around 11% from yesterday.
And at the start of this month, the big question we're all asking was how long will the market remain awash with liquidity? However, at this point, we are dealing with thinning liquidity levels. How concerned are you about this liquidity base as we go further into the rest of the month of September and the last quarter for the year? What do you think might pan out?
Also, for liquidity levels, this month, at the beginning of this month, has been quite tight in terms of market liquidity. This is largely due to some CR maintenance debit by the central bank that happened a couple of weeks ago, and that took out liquidity from the system. For that part of the market liquidity consequently went into a negative position, and that has hampered liquidity. But for the outlook for the month, we expect liquidity to improve as we expect coupon payments to come in from bonds, and the FAC will also be coming in towards the tail end of the month.
But also market watchers expect in the coming week?
In the coming week, we expect continuing activity. The bonds have rallied from 16.25, that closed at the auction on Monday, to close at 16.2, to trade around 16 levels today, rather. So we expect this interest in the bond space to continue next week. For the forex markets, we expect that the CBN will likely come in to intervene in the forex market next week to help with the liquidity supply in that space. For the rest of the quarter, we expect a liquid quarter. We expect more bond auctions and more treasury auctions to detect the pace of activity in trading.
Well, wrapping up the conversation, let's also take a look at the currency market now in terms of how the Naira has also been pegged, the value here. In terms of the volatility, what sort of rates do you think we might likely see going forward? Well, the CBN has already cautioned IMTOs against selling FX above approved rates and a whole lot more. But in terms of stabilizing the Naira, do you think we might be able to achieve that as the MPC also meets later this month as well? What new strategies do you think they can win to prop up the value?
So the CBN is part of their policy mandate to manage the value of the Naira against the dollar via their foreign exchange management policies. And what we've seen them release, saw them release a circular this week warning international money transfer operators against trading outside the approved rate. They said the approved rate is minus 2.5 to plus 2.5% around the closing Nigerian Forex Market exchange rate of the previous day. And we've seen a few of those IMTOs comply with that directive. Consequently, we've seen rates in the FX market stabilize between 750 to 780 levels this week.
Yeah.
So for their policies, they may continue to keep on their demand management policies that they've been implementing so far while they look to boost supply into the FX markets.
And the widening spread in terms of what we see play out at the parallel market and the importers and exporters windows, your take on how much of a spread we might likely see going forward into the rest of the month?
I don't think there's any spread that will be realized. In fact, because of their policies, I'm sure that is part of what they will be looking at and looking at how to close that gap. That is why they mandated the IMTOs not to sell too far from the official market rate. So we might see that spread begin to come down and close.
Tobe, thank you so much for speaking with us today. It's been a pleasure. That was Tobechukwu Ikpe, Treasury Team Member at Axis Bank.